Good afternoon there, guys. It's Saturday, April 2nd. My name is Dave Coker, and this is Talking About Finance. And you know the routine by now. We talk about finance because it's what me and my buddies get up to on a Telegram channel. And let's start out, as we always do, with a review of the markets. We'll take a look at the S&P 500 for the prior week. It finished up about 0.6% on the week. It's still down about 4.6% year to date, but a little slight improvement over last week. The VIX, sharp drop in the volatility index, down to 19.63. The 10-year note closed this week at 2.38. Oil closed at 99.38, down slightly week on week, but still up about 32% year to date. So markets are just sort of moving sideways, but the American consumer remains in good health financially. Corporate balance sheets and earning growth are both sound. We're likely to see inflation trend higher before it begins to drop. Some, in fact, are calling for a 10% handle or before it's all said and done. But with inflation the highest it's been for 40 years, I wouldn't be surprised to see numbers higher than 10% print. So now, stagflation seems to be the biggest concern. We've got inflation. We can't do anything about that. Stagflation is an issue. Oil's the driver here. Anything higher than $100 a barrel will likely see economic growth get whacked, inflation rising, classic stagflation scenario. The 2-year, 10-year spread on the yield curve is inverted, which means 2-year treasuries yield more than 10-year. And usually this signals a recession. You're getting a higher yield for buying at the short end of the yield curve than you are at the long end of the yield curve. Regardless, it does take time for the economy to tip into recession after an inversion. If we take a look, in 2019, it took about 6 months from the inversion for recession to emerge. 2006, about 23 months. 2000, about 14 months. I've got lots of data, so if anybody's curious, drop me a DM and I can share it with you. In this and all these other instances, the S&P 500 performed well until the recession hits. So keep the faith. Buy stocks. I won't say it's the only game in town, but you seriously need to be owning stocks. And by that I mean investing. Don't get caught up in this rubbish about day trading or swing trading or any of this garbage. None of these people that say they make money in the market swing trading or day trading, they will not tell you when they acquire a new position. They will not tell you when they exit. All you hear is about the profits. And it's total rubbish. It really, really is. I'm an open book in many ways. And I told you I put a very large percentage of my retirement capital, 67%, in gold and silver in March of 2019. And I added to that position in February. And now I'm up to 71% overall. There you go. That's disclosure. These people just do not do it. And I'm fully invested right now. You really need to be owning stocks. I am fully invested. And at the end of the month, I've got a problem, a real first world problem, guys, because my portfolio generates significant cash flow. So I've got to invest it somewhere. You can't sit in cash. That's ridiculous. And hence the problem. It's really a welcome problem. But still, I got to figure out what I'm going to buy and at what price. And yeah, it's a tough market right now because we're all trying to invest to get rich. This is off buddy's Twitter. And here you go. There's some simple rules. And I thought this was really cool. And I do cover some of this stuff in my wealth class. First of all, never borrow money to buy luxuries. Well, I'll generalize that a little bit further. Don't borrow money. Right? I just don't. Use credit cards like debit cards. I love Amex because it's a charge card, not a credit card. In other words, at the end of the month, if you spend $1,000, they're going to pull $1,000 out of your account. And that's perfect. It's not like you got to remember to do the payment or they take the minimum payment and the balance builds up interest that you have to pay. If you can't buy it twice, this is an interesting one. If you can't buy something twice, you can't afford it. Simple rule. I do like that. I've never thought about that before. Invest some percentage of the money you earn. I push that a little bit further. I invest 25% of every paycheck and then pretty much the same amount, 20 to 25% of all the cash flow from other sources that I've got. So the money comes in, I set some aside right away, I invest it. The remainder, save it, don't spend it. And the final rule, which again is something that I do teach in my wealth class and a remarkably large number of people don't pay attention to, spend less than you make. And if you do that, you'll be in good shape, except if the government gets out of control. And we've got this situation right now where the government, yes, is out of control. Here we've got M2, the money supply, M2 money supply. We're looking at the growth, yearly percentage changes. Now, M2 is a broad measure of money. they've got a couple different ways to measure it in the States. M1, relatively narrow, just essentially cash in circulation. M2 is broader. We're looking at deposits in banks and look at, as well as cash. And look at the way that M2 has expanded in the States. It's absolutely incredible how much it's picked up. Well, these actions have consequences. And here's something really wild. And again, this is off Twitter. I can't remember whose Twitter feed was. I should have grabbed the whole handle and everything. 82% of new cars sell for greater than the sticker. Once upon a time, you can go in and buy a new car and you could negotiate. You're not going to do it now. One of my friends just bought a new car and he said, God, don't negotiate. You'll end up paying far more. Yeah, I kind of believe it. It's a seller's market. They've got the cars. You want the car, you're going to pay above sticker price. Same thing with homes, 50% above the listing price. Before pandemic, roughly 20%. Look at the time it takes to clear a house. Houses are properties illiquid because it takes so long to move it. 90 days, over 90 days. A decade ago, now it's 17 days. That's wild. 11.25 million open jobs, 6.25 million unemployed, and 40-year high in inflation. Yeah, these are the consequences, but it isn't all bad news, or is it? Let's look a little bit deeper at this. We can see when we start to take a look at household income, when we try to figure out, and we got the gentleman who did this, Carpe Diem, has 3 different buckets: low income, middle income, and high income, defined as 35,000 or less, low income, 35 to 100,000, middle income, and finally, high income, 100,000 and more. Well, the good news is this: if you look at low income, it's declined. Sort of bad news is this: middle income has declined as well. Where's it all gone? It's all gone into upper income. Now, don't get too excited about this. We're seeing rampant inflation. And we've been seeing it for a while now, not just the past, year, 2 years, things like that. So I think, a lot of people are ending up in this higher bucket, but the money isn't going as far. And we've talked about this before when we discussed what happened to our money. And people know this. Market participants know this. People that are trying to invest know this. They're trying to get returns. And they're taking incredible amounts of risk. Really interesting story in the Wall Street Journal. If you subscribe, take a look at it. The riskiest bets in the stock market, they're most popular. These people are piling into all these oddball structured products. And by that I mean leveraged ETFs and inversed leveraged ETFs, just to name but 2. Never do that, guys. You never take margin. Whether you're getting a margin loan for your broker or purchasing a leveraged ETF, at the end of the day, it's all the same thing. You never do that. And yet people are doing it because they're trying to, I think, just keep their head above the water. These are bad times economically. Oh, here's an interesting one. And we know what happened to the ruble. When Russia invaded Ukraine, it got whacked in a major way. And you can see there's this huge drop in ruble against other currencies. And it bounced back. It's all the way back pretty much to the pre-invasion. What do you think did it? Well, that's nothing that 20% interest rates in Russia couldn't fix. It is a thing, right? I'm not tempted to go into Russian debt or Russian products at all, but it's interesting to think about this. Of course, we know that as interest rates rise, a currency becomes more attractive simply because any deposits in that currency will grow faster than, say, a Eurozone currency where the base rate is effectively 0 or in real terms negative. So yeah, 20%. Don't ask me what the real rate of return is. I honestly don't know what that is. But we're all looking for protection from this mess that the Western democracies have gotten us into with just printing money. Yes, we're going to talk about Bitcoin. Oh, I'm sorry, we haven't been properly introduced. My name is Dave Coker. It's Saturday. Yesterday was Friday, and every Friday I buy Bitcoin. I've been doing it for years, and this is cool. And I've got an infographic coming out soon about this. If you don't get my infographics, poke about on my coker.me site, and you'll find them. This is wild because we know MicroStrategy bought a whole bunch of Bitcoin. And they've got it on their balance sheet, and now what they're doing is they're staking it. So they're using the Bitcoin, some of the Bitcoin on their balance sheet. They're staking it in a loan. They're getting a loan of USD from Silvergate, who's a cryptocurrency bank. And they're going to use that to buy more Bitcoin. Yeah, I think that's pretty cool, actually. And of course, you and I could do that through DeFi. It's a very common strategy. And here's something. I don't know the gentleman myself. I've just recently become familiar with his work. He's got his Twitter handles down there. Take a look at it. What he's doing is he got something called the liquidity index or the liquid index. And you can see here, we've got the halvings, halving 1, halving 2, halving 3, and you'll notice something profound. Every time there's a halving, shortly, sometime after, there's a peak in prices. And that peak manifests, it holds. We have the second halving, and once again, there's a peak in prices. We can see it dropped a little bit, not as severe. It certainly didn't go down to what it was before the second halving. Third halving is upon us. We're running up in prices, and people do expect this to be a fairly decent run before we move into halving 4, which is in May of 2024. I believe it's the 24th, but don't hold me to that day. But it's definitely in May of 2024. So yes, we're always going to have Bitcoin. No, I don't think you should be holding cash. If I had to choose between cash and Bitcoin, well, I do that every Friday. I make a choice. I buy Bitcoin every Friday. You should buy Bitcoin regularly, whether it's once a week, every other week, once a month, once a quarter, twice a year, once a year, doesn't matter. It's called dollar cost averaging. It's a very effective strategy. All right, guys, thanks for listening. You're going to have an awesome week. We're all going to make buckets of money. Just make sure you invest well. You don't try to trade. Remember, day trading, swing trading, it don't work. We've got the data from the U.S. tax authorities. These people lose money. So invest. Hold on. Whatever you're investing, just hold on. Have a good time. Take care, guys.